People like the idea of investing in stocks that pay dividends, as it enables them to generate a regular income stream from their investments. And if this is something that appeals to you, then investing in a dividend ETF might be a good way of doing this. But where do we start? With so many fund providers, fund names, and nuances between funds, how do you know whether the one you choose is the right one for you? To help you with your research and to making a more informed choice, in this video, we're going to look at what an ETF and specifically a dividend ETF is, some of the factors that you might want to consider when making your choices, examples of some of the popular current dividend ETFs available, and a brief talk through how to use free ETF comparison site, justetf.com, to help you with your analysis. None of the ETFs featured in this video are my preference or recommendations, by the way, and this is a financial education video and is not financial advice. What might be right for one person might not be right for you in your individual circumstances, so do your research before making your choice of what to invest in. Fact check what you were told on YouTube, including what I say on this channel. If unsure, consider seeking financial advice from a suitably qualified professional, and remember that when investing, your capital is at risk and you could end up getting less back than you put in. An exchange-traded fund, or ETF, is an investment fund that trades on stock exchanges, much like a regular stock. It holds a collection of assets, such as stocks, and typically aims to track the collective performance of these stocks in a specific index to provide that index return. Indexes are used as performance benchmarks and are really just league tables of stocks or other assets that have been grouped together on certain characteristics, such as countries, sectors, asset classes, or specific themes such as ESG. Some key points about ETFs are that they can offer exposure to multiple assets within a single investment, reducing that risk, putting all your eggs in one basket to provide diversity. They trade throughout the day, allowing investors to buy and sell easily, and therefore providing generally good liquidity. Many passive ETFs have lower management fees, as they use cost-effective methods to replicate the index that they track. You may have noticed that ETFs often have two different versions of the same fund, and you might therefore have come across the words accumulation, distribution, and income. Accumulation ETFs automatically pay the dividends paid by companies back into your investments. This is potentially a good low-maintenance choice if you're investing for the longer term, whereas distribution or income ETFs will pay those dividends directly to you, and it's then for you to choose what to do. This does mean that distribution ETFs are necessarily specialist dividend ETFs that are designed with companies paying dividends as an objective. So it's important to differentiate between funds that pay out dividends and those that are constructed with dividends in mind. And it's the latter that we're going to feature in this video. As we go through the video, I will be using words such as total return and yield as we discuss individual ETFs. The dividend yield is a financial ratio that indicates how much a company pays out in dividends relevant to its stock price, and it's expressed as a percentage. This helps investors assess the income potential of an investment. The dividend yield of an ETF, instead of being based on a single company's dividend, represents the cumulative income generated by that ETF from the basket of dividend-paying stocks. In seeking ETFs with the best dividend yield, you might become blinkered in looking at a yield figure in isolation. Beware of this, as apart from the fact that high dividend yields do not necessarily mean good companies and could be a red flag to underlying issues, the good companies that also pay high dividends might therefore reinvest less back into the company for their own growth, leading to potentially lower capital appreciation when comparing them with other non-dividend paying stocks. When a company pays a dividend, the value of the stock is potentially affected, as money is taken out of the company to pay a shareholder. So if you want growth to sustain your portfolio, if you intend to take dividends, you might ideally consider picking ETFs of good companies who pay reasonable dividends, but who still provide growth or the potential for it. This then will allow you to obtain a steady income stream without you having to sell assets. Checking past performance total return figures, which will include the yield, will be a start in identifying growth prospects of an ETF, alongside those separate yield figures for your chosen ETF. But with all that being said, we should not solely rely on what the past performance of either the dividend yield or total returns has been when making our choices. Just because an ETF has performed well previously does not mean it will continue to do so, and past performance should only be used as a small part of your total research of what might be suitable for you and your circumstances. So let's look at some ETFs, with the first one being a relatively new one, and is the Global X Nasdaq 100 Covered Call UCITS ETF. This has an identification ticker of QYLP if you want the sterling option. It's distributing and comes with the TER or OCF of 0.45%. Its fund size is £349 million. This is not the biggest, but it is new and will potentially grow as it becomes more established. It seeks to track the Chicago Board Options Exchange, CBOE, Nasdaq 100 Buy Right Index, which is an index that tracks covered calls on the Nasdaq 100 index. The Nasdaq 100 index itself includes 100 of the largest non-financial, predominantly US-based companies and is very tech-heavy. So there's reduced diversity and potentially increased price volatility with this one. A covered call is a trading strategy where an investor holds shares in a security but gives a buyer a right to buy these shares at an agreed price before the call's expiry. For this, the investor collects a premium, which generates additional income to the dividends. But if the stock market surges, the investor will miss out as the buyer might exercise their right to buy the shares at the predetermined lower price. This therefore tends to stunt growth, but with the trade-off of there being a potential for increased income. And you can see how the income strategy has worked so far with this one, with the current dividend yield being a large 13.07%, with consistent high yields since the fund's inception date of November 2022. Given that this ETF is newer, there is no risk data yet on Just ETF, other than the 1-year volatility figures to gauge the riskiness of this one. One thing of note to mention in the figures provided with this and the other funds featured in this video is that the OCF or TER will be higher with dividend paying funds than it will be with normal standard equity ETFs. The OCF or the TER is the fund administration charge, and with dividend ETFs, the costs are often higher as they tend to rebalance more frequently, leading to higher transaction costs to maintain their yield-focused portfolios. Essentially, you're paying a bit more for a specialised structure, strategy, and potential yield enhancement that dividend ETFs aim to provide. And those higher costs might not mean much in the moment, but really do have the potential to eat into your returns in the longer term. So you'll have to decide whether dividend ETFs and their overall returns justify those costs. The next ETF is probably the most popular global choice of dividend-paying ETF, and is the Vanguard FTSE All World High Dividend Yield UCITS ETF with an ID ticker of VHYL. It's distributing, but there is an accumulation version also with a ticker of VHYG, and this one has a lower TER or OCF of 0.29%, with a big fund size of 4,423 million. The bigger the fund size, the better the likely liquidity and the lower cost to investors, including TER and transaction costs from buying and selling. Smaller funds are also susceptible to bigger price swings or the risk of closure, as they may fail to attract bigger institutional investors to provide that support and stability. This large fund seeks to track the FTSE All World High Dividend Yield Index, which is comprised of large and mid-sized company stocks, excluding real estate trusts in developed and emerging markets that pay dividends that are generally higher than average. Unlike your average global equity ETF, this one targets the best dividend payers rather than the best growth companies. Given that currently most of those big growth companies are US tech companies, you can see that US exposure, although still high, is reduced here, and financials is the biggest sector, with technology being well down the list. This tends to make this fund a bit more diverse than your average global equity fund, with the top 10 companies, Magnificent 7 US companies all excluded, accounting for a smaller 12% of the fund. This ETF is consistent with a current yield of 3.14% and yield exceeding 3% over the past 5 years. When looking at the reasonable 5-year performance figures of 65.4%, you will see why many investors are attracted to getting regular, consistent dividends and maintaining growth in a global diverse fund with this one. We stick with a global theme for this next ETF, which is Fidelity Global Quality Income UCITS ETF Sterling Hedged. This is identified with the ticker FGQP, and the unhedged version is FGQD. Being sterling hedged means that some of that foreign exchange currency risk is reduced, and this is something to consider. And all of these funds featured as domiciled in Ireland, meaning no additional withholding tax applied to the dividends. Remember though that if your ETF holds stocks from countries that impose withholding tax on dividends, such as the USA, the ETF may be subject to withholding tax before distributing dividends to investors. And this will apply notwithstanding you holding your investments in tax-efficient accounts such as pensions and ISAs, so dividends paid to you might be less than those published or calculated. This ETF offers a distributing version only, with a TER or OCF of 0.45% and a smaller fund size of 52 million. It tracks Fidelity's own Fidelity Global Quality Income Sterling Hedged Index that consists of high-quality companies from developed markets which offer high dividend yields, and a minimum of 50% of the companies are also deemed to maintain desirable environmental, social and governance characteristics. Having quality factors doesn't necessarily mean that the large and mid-sized companies included pay the biggest dividends as a percentage of their share price, but that they are included because of their fundamentals, such as balance sheets, profitability, cash flow, and growth, for example, and that they pay a significant amount of dividends because of their company size. That is why some of those Magnificent 7 US companies, who don't pay large dividends per share, still feature in the top 10 in this one, with that top 10 weighting accounting for a larger but less diverse 22% of this fund. The USA also has higher exposure and well above standard global equity market cap of 69%. And technology sits at the top of the list, taking up 25% of the ETF. These holding figures are useful to help you with your research to ascertain how diverse the fund is, and you can already see with this one that it's less diverse than VHYL. Given the quality factors incorporated into this ETF, you would expect a lower dividend yield as a trade-off for higher overall performance. And the current yield for this one is 2.15%, with a consistent yield of well over 2% being delivered over the past 5 years. 5-year total return performance figures are 79.38%. So if the past is anything to go by, you might expect a reasonable consistent dividend yield with reasonable overall total returns going forward. But remember that past performance is only a small part of what we should consider when deciding on what ETF to choose. And always look at all the relevant data carefully before making your choice. And for the last ETF today, I'm getting into home territory. I considered featuring specialist dividend ETF, the LNG Quality Equity Dividends ESG Exclusions UCITS ETF, ticker LGUK, and even about featuring a standard FTSE 100 distributing ETF in the Vanguard FTSE 100 UCITS ETF with a ticker of VUKE, which has provided a consistent yield of around 4%. But the one I eventually opted to feature is the iShares UK Dividend UCITS ETF, which you will find to be distributing only and comes with a ticker of IUKD. This has a TER or OCF of 0.4% and a fund size is 943 million. The ETF passively tracks the FTSE UK Dividends Plus Index. This index is designed to follow the 50 highest yielding UK stocks from the UK FTSE 350 index. And the FTSE 350 index represents the performance of the 350 largest companies listed on the London Stock Exchange. This index of 50 stocks is weighted according to dividend yield, with a cap of 5% on individual companies, as can be seen from the top 10 holdings, representing almost 40% of the fund, with just under 30% of companies in the fund being from the financial sector. Whilst it offers diversified exposure within the UK dividend space, it is concentrated in high yield stocks, largely from the financial sector, and is not broadly sector diversified. The current yield on this one is 5.05%, and this ETF has consistently performed even higher over the past 5 years. 5-year performance figures are the most impressive of all these featured today, with total returns of 86.22%. So having featured 4 ETFs in this video, let's now compare our shortlists by using the ETF.com screener. I'll leave a link in the description box below for the UK version, and in case you were wondering, I'm not affiliated in any way to this site. I just find it a really good comparison and analysis tool. So firstly, start by entering the tickers for the funds chosen into the search box, and once on the fund's front page, click on the compare button. Then go back to the search bar and enter the next ticker. You will see the orange circle with the number of funds you wish to compare at the top right as you've clicked the compare button. Once you have all your funds registered, click on the orange circle and click Show Selection to bring up that full list. Click on Select Columns to bring up a drop-down list of whatever you want to include in your comparison data, and this will then allow you to get the data that you want to compare in the side-by-side columns. If you want a more detailed comparison, click the orange circle once more, and then click on Compare Selection in Detail. In finding a suitable dividend ETF for you, don't make your choices based primarily on past performance. Drill down deeper into holdings and portfolio data to help check on the fund's diversity and to see if it provides the balance that you need. Look at the companies in the ETF, and remember that higher yields doesn't necessarily mean good quality companies. Look at how the index functions. We've talked through some different index methods in this video, but there are more. Check the fund size and its liquidity, and if using ETF.com, also consider the risk figures that they provide. From these you can ascertain which fund has been the most volatile, which gives you the best return for the risk you take on, and what the maximum drawdown is. A maximum drawdown is a measurement of the largest peak to trough decline in a given period, which will give you an idea of what to expect in a bad case scenario. Please shout out if you have any questions or comments, and thanks very much for watching.